Tēnā koutou katoa. Welcome to today's CFA New Zealand Faking AI webinar. I'm Shane Solly. I'm a portfolio manager with Harbour Asset Management. I'm a CFA charter holder and a member of the New Zealand CFA Society Board. I'm delighted today to be joined by Dr. Joseph Simonian, PhD and CFA Institute affiliate researcher. Joe's joining us today from California, so welcome, Joe. Today, Joe's going to discuss his work on the increasing popularity of AI investing, the growing use of AI washing, and the underlying motivations for companies and organizations to engage in AI washing. Joe's a 20-year plus veteran of Wall Street, so well done, Joe. That's a big haul, and one of the street's leading quants. But before I hand over to Joe, I've got a few housekeeping announcements. There always is a housekeeping announcements. And it's about the CFA New Zealand Society events. We've got some fantastic events coming up for members, all of which you can see on the CFA website, including we've got our spring networking drinks starting in Wellington on the 8th of October at Astoria, Christchurch on the 16th of October at Duck Central, and Auckland on the 23rd of October at the Lula Inn. Jump in, and if you need to get more details, jump on the website. In terms of other webinars coming up, we've got our interest rates on the MOVE webinar on the 21st of October. Some great speakers, including Adam Richardson from the RBNZ, Mary Jo Vergara from Kiwi Bank, Zoe Wallace from Forbar, and Christina Leung, our own Christina from CFA, as well, speaking there. Then we have Unlocking the Power of Alternatives on the 4th of November. That's in person and online. So if you want to hear some real important new stories and news from some of the key venture capital, private credit, infrastructure, real estate, alternative folk, come along to that one. And then finally, the biggie on the 4th of December, we have our New Zealand Investment Conference for CFA. Some fabulous global speakers coming through. So certainly worth taking a look at, whether you're looking to expand your network, sharpen your skills, stay up with the latest trends. We think this is a real must attend. And really importantly, we know the tickets will sell out fast for this event. So get yourself into the early bird tickets. Okay, let's get back to today's session. We've made sure there's lots of time for questions at the end. So start thinking about what you might want to talk about or what you might ask. Dr. Joe, just a reminder, the session is being recorded. We'd prefer if you use the chat box at the bottom of the questions here, of the session here. But firstly, Joe, just to remind you, this is not a how to do it session, right? It's an opposite of that. It's about the tips and tools to actually try and identify where individuals or businesses are falsely or inaccurately claiming scenarios, leveraging AI to enhance their investment process. So, Joe, welcome. Thank you very much for coming along today.
Thank you, Shane, and welcome everybody. Glad to be here, as always, with the CFA Institute. Let me share my screen and get into it. I don't have too many slides, and the reason is because I want to make this as interactive as possible. And so, we'll get some questions at the end. And it's one of those, with just, hopefully everybody sees that, with a little bit of setting up, if you will. Let me get the slideshow going here. There's so many residual topics that come out of it, right? That there'll be a lot to talk about. So
maybe Joe, maybe if I just run through your background, Joe, if you pop up the next slide, which is, Joe's got 20 years plus of experience within the sector, and obviously done some really impressive research pieces for the CFA. Thanks, Joe. And one of the things that we're sort of looking at here is Joe's had experience fundamentally as a quant. So, comes from a very strong academic background here, authored over 40 publications in a range of different investment journals. And so I think, really well positioned here to understand, firstly, the benefits of using quantitative approaches within our investment processes, and then also why we need to be a little bit wary about what people are purporting to do. Some of the statements people are making about, AI is driving their processes and what that really means. So, thanks, Joe. I think if we jump into your presentation pack. I think, certainly a great background here from Joe's CV.
Yeah, and I was actually doing a little review the other day, and it's actually over 50 publications. Not that I follow that stuff.
Oh,
I gotta
that's
up,
great. It's
yeah,
amazing. There's
I
not
gotta
many
up.
people I know that does that. Yeah.
Anyway, so let's get into it, guys. Okay, so AI washing is what we've been describing, and what you may think it is, just like ESG washing, right, or sustainability washing, which we've heard of, which came about for the similar reasons. Sustainability was and is a big topic, and people want to show their sustainability bona fides, if you will. And by the same token, many investment firms, especially quant firms, but other types of firms, which we'll talk about as well, want to show that they're up on the latest and greatest AI technologies. They're really applying the methodologies and tools in substantive ways. That's the key term here, not just in superficial ways, because they think that it will give them an edge in their business and in terms of their reputation and so on and so forth. And just like any business, you're never going to look good if you are considered old hat or not really evolving with the times, right? And from a product standpoint, or let's think about the investment industry from as a provider of products, right? We don't often think of that way. Of ourselves that way. We think of ourselves as providing a service, and that's true. But in a sense, we are a provider of products as well. Investment products are products kind of like others, whether it's a table or pharmaceuticals. Obviously, each industry has its own details that are important, dimensions. But if you think about a product provider of any kind, one of the worst things they can do is to be misleading and opaque about the products that they're providing. And AI washing feeds into that idea that, look, hey, you guys are telling us that you will be providing this kind of a strategy. Let's say it's a quant strategy, and you're claiming that it has these features. A set of those features is artificial intelligence and machine learning based. Now, if you're not really using those techniques in a substantive way, substantive, we'll get into that, meaning a real part of your process, but just superficially, so that you in a pitch you can say, hey, we're using AI. Well, that's misleading. That's actually not being true to the product that you are selling. Now, I will say that if in the piece that I wrote on this for the CFA Institute, I cited that there was a well-known NVIDIA study that's put out in 2025, and they obviously interviewed folks in 2024. And it's specifically centered on the investment industry or the financial industry. And you'd be surprised, perhaps not, but that there's been a marked increase in the firms saying that they are using AI and machine learning and data science tools in substantive ways. So all of the categories, whether it's risk or trading, they're pushing 30, 40, 50% sometimes, which is a lot, actually, compared to a few years ago. And so while we're not at the stage of peak AI washing, if you will, we may be headed to a place where it's going to take due diligence and increased scrutiny to figure out who's actually doing it and who isn't. And we'll go into the reasons why folks do it and some don't. And so I guess the message here, first and foremost, is that yes, what you've heard is true. These tools are being used much more now in our industry than they have been in the past, number one. Number two, while AI washing isn't an issue yet, it's not an epidemic, it could become a problem as time goes on. And there have been public enforcement actions that have already been taken. I won't mention them because I don't recall all the details. But these were done by regulators who actually felt that they had enough evidence to cite one or two firms with the grounds that they were actually advertising the application of AI technologies that was different from the ways that they were actually using it. So that's actually a first, because an important first. Unfortunately, it's sort of a sad first. But it's good that regulators are actually getting on top of this, because if they don't, this could run rampant at some point. And we'll talk about what they need to do to actually get better at it. Okay. So what are the signs of AI washing? Well, a lot of buzzwords can be used in ways that we may think are innocuous, sort of innocuous or benign. But in reality, they imply things that they shouldn't be implying. So, for example, AI powered is one of the more loaded terms. Now, if you see this, the whole idea is like the old Intel inside, that whole slogan. And the idea there was, hey, you have this computer and it's built by whatever PC manufacturer, but it's the Intel chip that's inside of it that's the important part, right? It's a fundamental part of what's making this machine work. Similarly, an AI powered or deep learning powered, AI based, machine learning based, they may seem like they're innocent terms, but in reality, what it's telling you is that the primary driver of this process is something related to AI and machine learning. If you use those buzzwords, but you're using the tool in a very tangential way, and I'll give you a lot of examples about this, then that's misleading, and that has to be explained because it's not really AI powered, right? It's not. That's on the product level, right? Now you could also say firms will often say we have an extensive AI program here at this firm that but they don't really they can't explain how folks are trained in AI at the firm. They can't tell you how it's consistently applied, how decisions are impacted by AI, right? So this extends beyond products. It actually touches on, firm processes, the actual integration, if you will, of AI and machine learning in what the firm is doing. And that's also misleading. And I bring up all these different tiers because a lot of times, some of it can be unintentional, right? So a firm uses AI for some simplistic task, and then they say, well, what's wrong? We're using AI. But that's not what people understand by AI usage. They think that you're actually using things in a real way. A main area where this happens is routine automation. So automation in and of itself doesn't involve AI. Why not? Because AI or machine learning, at the end of the day, what does it mean? I'll give you a simple definition. It's the replication of some aspect of human beings' cognitive processes. So that can be our visual processes. Think about a guidance system in a jet that's better than our naked eye. Okay, that's AI potentially. Think about memory. That's another process. If a computer or a system has a better memory than we do, that's, I guess, a very low form of AI. Pattern recognition, that's a major one. So all of us can recognize patterns to differing degrees, right? My son, for example, is excellent at it. His visual memory is fantastic. We can go visit a pizza restaurant that we visited last year. He'll look and say, oh, they changed the tiles. And we'll say, no, it's the same color. He goes, no, look in the corner. That tile used to have a crack in it. They fixed it. This is so he's like a little AI in pattern recognition on the visual side. That is a AI would be that is an example of AI pattern recognition done at a manner and magnitude and strength and power that we cannot do it. That is AI. So routine automation is not so much AI. Think of it. What do we do typically? Let's say in a non-automated process, somebody's working with Excel spreadsheets and manually doing things. And then you write some Python code to do that automatically. Now, that's not useful. That's useless. It's very useful. I've helped people have done in my career. I've done things like that too. Not everything is exciting and sexy and a headline grabber, right? But that's not AI. That's a useful use of computing and automation. And congratulations, pop the champagne. That's great. But it's not a replication of any cognitive process. And that's what we're getting at here. Now, the last point is important because often what will happen is that AI or machine learning will be used in a way that is real, but not really additive, right? And so I'll give you an example. I'll give you one. I'll throw an example out now. So let's say there's an investment firm that has an investment process that they're using, and it's their traditional investment process. But then alongside it, they have, let's say, a rudimentary machine learning algorithm running the same exact process. And then if you ask them and they were honest, you'd say, well, how much are your end decisions influenced by the original process versus the machine learning process? And if they told you, and this is often an answer you get, well, the AI process is just used as a second opinion, but ultimately the old process is what drives our decisions. If they go out and then they say we're AI driven, that's washing. Because in reality, let's be honest, that AI algorithm or ML algorithm has no real role in the decision-making process. It's more or less a bystander, and it's a way for them to get a second opinion that really has no impact. It's almost like you have a medical doctor giving you the prescription, and then you ask your nephew, who's a medical student, what do you think? And then you immediately disregard what they said. Now, that medical student may be a genius, actually may be more talented than the doctor you're using. But if you're not using your nephew's knowledge at all, he or she has no role. Well, it's a nephew, so it's a he. He has no role in your decision making process, right? And so there's some subtleties to this, but that's kind of where you can start detecting things. And we'll talk about the science again a little bit, and then we'll go into the reasoning, because people are probably thinking, well, why would anybody do this? And there are really good reasons, but let's get some more science. In the white paper itself, I have a whole questionnaire, by the way, that you can peruse, and it gives you an idea of the level of depth that you actually need to go into in terms of really understanding whether or not firms are using this stuff really or not, and the implications. And I've told this to some regulators that I've spoken to, consulted with in the past, is that yeah, you guys may have to get skilled up a little bit in these technologies to actually do some of the due diligence that you want to do. So there is a whole sort of skilling up and learning aspect to various folks, but including regulators. Now, other signs. First of all, if a company can't provide any real world example or a real product. So, a lot of firms out there now that use this stuff actually have products that are machine learning or AI driven, and they can point them and say, look, hey, for better or worse, this thing goes out and reads filings from companies. This is simple, but let's say it does it, right? And all the decisions are made on that. Well, you may say that's a really kind of shoddy way to use AI, but it's legitimate. If they're actually doing the scraping of the filings, and all the decisions are being made based on what it's gaining from those filings, and there's nothing else more or less going into it except maybe data cleaning or whatever, then that would be a legitimate use of AI, even though we may disagree with it as being a good use of AI or an effective use of AI. That would be in the performance. We have to figure that out later. But if they don't have any products that have any real AI components or machine learning components that they can point to, it's not in their decks. Or if it is, it's just given lip service without any detail. That's a huge sign. Now, all of the symptoms I've spoken about so far are all interrelated. Now, the next one is one that's kind of shocking, but it's probably the easiest one to figure out, which is lacks AI specialists. You say, what do you mean they have quants? Well, let me give you an example. If you go out to any major tech firm, I'm talking Mag 7 type of a firm, you go to their AI departments, I will challenge anyone to find them staffed by folks who haven't contributed to the field, or are known in the industry, what have you. Okay, it doesn't mean they're perfect, doesn't mean they do everything right, they don't make mistakes, doesn't mean that they're not overpaying for some folks, underpaying for this. That's not my point. My point is that they will not put a faker, if you will, or somebody who's just a old hand in the company who's lying around as their head of AI. Technology firms whose primary product is some kind of technological product have to have qualified individuals in those positions, or else they will fall behind rapidly. If you don't believe me, Andy Grove at Intel has a famous book, Only the Paranoid Survive. Tech firms are paranoid with good reason, because if you're even 6 months or a year late sometimes, you're going to be destroyed, right? And they are very concerned with this, and the proof is in the personnel that they hire. Investment firms, on the other hand, you'll often find heads of AI that have just the only qualification they have really is that they've worked at the company for 20 years and they have institutional knowledge, which is not which has some value, obviously. But hey guys, let's be honest here. Some of these AI systems, most of them, they require specialized skill, whether that's coding, whether that's working on the architecture, the plumbing, algorithm design, data, whatever you want to call it. So to just put an old hand who's been at the company for 20 years and they're a partner as the head of a division whose job is to essentially push the frontiers of what this firm is doing is a recipe for disaster. But I can just to go take a look out there who runs AI at least half the Wall Street firms are people who I'm talking about. Now, the other half understand this and they have actual qualified people in those seats, right? But there's a good deal of them that don't. And that's the first question you should be asking. Who's running this stuff at your firm? I actually interviewed fairly recently a year ago, year and a half ago, with a firm. They had tried to recruit me for head of AI. I had been speaking to them for a number of years, and they came to me and they said, and I asked them, well, why did it take so long to kind of resume the conversation with me? And they said, well, we had a bunch of quants, and we figured at the end of the day, we can do it ourselves. And I realized I could never join this firm, because a firm with an attitude of, hey, we've got quants, they can just figure it out. Well, quantitative background is not necessarily AI background, right? They can be interrelated. For example, I lucked into this because I came from mathematical logic, which is by extension related to computability theory, which also involves various logics that are used in AI, like modal logic and epistemic logic. So even before this stuff became hot on Wall Street, I had studied this decades ago, literally decades ago, right? And so when this stuff started to roll around, all the papers that I had stacked up that I had written that nobody wanted to accept in finance journals automatically became hot topics. As a matter of fact, when we were founding the Journal of Financial Data Science with Marcos Lopez de Prado and Frank Fibozzi, we had our first editors meeting, and Frank says, look, we have the first issue coming out. Do you have any papers? I said, Frank, I've got a stack of papers that nobody wanted to look at for 10 years. Here they go. And then so I had 2 papers in the first issue, right? And my second paper in the journal was already ready to go, more or less, right? So the point is that a lot of quants, though, don't come from this background, right? They come from derivatives pricing, physics, areas of math that are unrelated to computing or artificial intelligence. And yes, they can learn it after a while. They're technically competent, but it's still a learning process. So to say, hey, read a book, Tib Shirani, and whatever, and figure it out. It's in chapter 10, this model. It just takes a lot, just like with any endeavor in quantitative finance, it takes a lot of experience, a lot of failures to start to understand how to apply something. And you can't just be a quant and do that. And so what the firms that have done, and I won't name them obviously because they're not paying me, but the firms that have been most successful at this actually realized this years ago and started to recruit people specifically for these types of positions. Because I don't care what anybody says, if you've studied particle physics for 15 years, you can't just jump into AI. You have to do some learning. Maybe that learning only takes a year or so, but you have to get some training, and your whole mindset has to change, because the algorithms are not the same as they are in physics and math, especially, right? Because a lot of the models in machine learning and AI are heuristically driven, right? It doesn't mean they have no connection to statistical theory. They do, but they often are a little bit less, at least rigorous to a physicist or definitely to a mathematician, right? And it's because they are essentially trying to do pattern detection, first of all. Second of all, they have fewer theoretical inputs than a lot of other models do. For example, econometric models, which have a lot of economic theory in them, right, that actually form their basis. Machine learning models, at the end of the day, to simplify, right, and to maybe make light of it a little bit, they're basically pattern recognition devices at the end of the day, right? Yes, a lot of them do other things. I'm not trying to belittle it. I'm a fan. I'm obviously a supporter of it, but I'm just saying that they are fundamentally different than a lot of the models that were used. They're much less reliant. They're much less focused on explanation, much more on prediction and pattern recognition. And if you want to pay famous paper on this, a non-technical paper, the actual one of the creators of a very famous model called random forest, Leo Breiman, has a very famous paper called The Two Statistical Cultures. And he was a UC Berkeley professor initially, and then he left academia to work in industry for a while. And he wrote this paper because when he came back, he realized that the way statistics is applied in industry is much closer to the way how AI and machine learning models are built than how academic statistics is taught and practiced. And basically, the industry way of using stats is much more empirical, less theoretical, more focused on results, more focused on prediction, right? That you can see that it makes itself actually much more amenable to investing applications. And so it's not just a learning curve in terms of technical learning, it's also a mindset. And if you don't have that mindset and the requisite background, you're not really fit to apply these techniques, right? And especially for a lot of quants who come from a regression framework, they have to get used to a new way of explaining output. For example, things like deep learning models or even random forest, they don't have the equivalent of betas, right? Coefficients, like in a regression. they have simple things that you can get at those ideas, right? But you often have to have heuristics. So, for example, in a paper I wrote on this in 2018, I think it was the first paper ever to apply machine learning to risk factors. We created something called a quasi-beta, just to make things understandable to folks who would be in a regression mindset, right? So there's just, things that can be worked around. My point, though, is that it takes specialized knowledge, and it just can't be like, oh, hey, read a book and now run an AI department. And so the first line of sort of BS detection, if you will, or due diligence is really the personnel. Okay. Now, another thing is interesting, exaggerated claims. Now, often what will happen, there'll be people at a firm that actually know what they're talking about, but they will sell AI and machine learning as if they're able to do everything under the sun. And that's also another different way of AI washing, because we have to understand that these things are just one other statistical tool in our toolbox. They can provide many useful benefits potentially, right? Sometimes, as in the case of large language models, they can almost seem magical, right? But at the end of the day, they're a tool like any other, right? And we are definitely not at the point yet of, I don't know if you're any of your Star Trek fans, but we haven't created Commander Data, who was an android on the Star Trek The Next Generation. I don't know how nerdy you guys are, but I'm a big nerd on the sci-fi side, right? And we're a long way. I hope we get there soon, but we're not there yet. We'll talk about that as we go along a little bit, but that's the idea. So exaggerated claims are also a big part of AI washing. We have to watch out for that. Now, this is coming from some of the questions I had, right? So signs of AI washing, if they can't be clear about the exact model, so if they say, oh, we use deep learning, but they won't tell you if it's a recurrent neural network or a neural Turing machine or whatever it is, right? That's a huge sign, because they can't hide behind the secret sauce defense. If I tell you, hey, I'm using a neural Turing machine, that's the base of it, I can't go home and replicate your strategy based on that. Right? I mean, you've got to tell me so much more. And even without your plumbing, I could never really trade what you're trading and do what you're doing. So if they're not willing to give you even like the minimal level of technical detail, telling you what specific model, and they're keeping at the level, hey, we use ensemble methods or we use deep learning, that is really an extremely superficial level, and you'll never be able to understand what they're doing, right? How is the AI trained? For example, how big are the samples that you're using? Do you use synthetic data to validate your models? How do you ensure quality of the data in the context of machine learning models? Machine learning models are often very free form, meaning that they don't have all the checks that even a regression has. So, for example, you could use highly correlated inputs into a machine learning model, and it will generally process the data. It won't detect it. Versus a regression, yes, or old friend regression, which will say, oh, this is invalid because your matrix has variables that are highly correlated, multicollinearity it's called. When you have input variables, explanatory variables that are too highly correlated, your regression will be invalid. I mean, you can run it, but the results are unusable. Machine learning models will process anything. And although they don't look at just linear relationships, they look at nonlinearities, interaction effects, a lot of things. You have to do all the checking yourself. For example, maybe I want linearly independent factors first. Let's settle that issue. And then I'll dump those into the model, because then I'll know that, okay, I've got linearly independent factors. Now let's see how they look on the nonlinear and interaction side of the story, right? But I just gave you an explanation of how I would do something. Can they provide a similar explanation of how they did something, right? If they can't, that's an issue. A lot of data is non-stationary. It's not always a huge issue in a machine learning model, but have they considered it even? If not, oh, that's interesting. I didn't know that you have a random forest model that can actually doesn't need to have non-stationary. That's interesting. Can you tell me a little bit more about it? Right. So as you peel away the onion, the layers of the onion, you're getting more information on, are they really doing something or not? Right. What problem does AI solve, except, let's say, furthering the careers of the people that are involved in that project, right? Why did you even use it? Because, of the first rule of any kind of model application is, it's really, if it ain't broke, why fix it? If you can solve every problem under the sun with the linear regression, you would. Why would you do anything else? So what was the specific investment problem that your current models didn't solve? And how did the AI solve it, right? You'd be surprised the blank looks you get if you ask these things sometimes. Okay, How do you measure performance? Are you looking at RMSEs? Are you looking at R squares? All of the above, which is given more importance? Right? So I just give you a bunch of predictive stats. I mean, RMSEs are clearly predictive. You can have predictive R squares too, right? They're called scores, right? In things like scikit-learn or other, kind of using machine learning applications. So how are they measuring success? If it's a predictive context, I gave you some ideas. If it's other context, there's got to be other measures of success. What are they, right? I'm not saying there's one size fits all, but they've got to have these answers ready there for you, okay? How is AI performance measured? Do you have any stats or metrics that you've been keeping that shows us that AI has been improving your process? Or is it just twiddling thumbs and saying we're doing a lot of cool things, right? How do you improve the AIs over time, the AI tools that you're using? Is there a uniform process to doing this? If not, that could be an issue. If it's all ad hoc, that brings into question whether your firm is committed to this or is just doing, project by project applications, and that should raise, alarms as well. So there's a lot of these questions and more really help you get deeper into the extent and reality of firms' usage of this stuff. And if they're really drawing blanks, if you're drawing blank stares on all this, that's a huge sign. Or if it's a lot of, oh, we're working on this, we can't reveal this. I mean, that's another sign. I mean, there are limits to what they can reveal, but nobody goes and asking, hey, give me everything I need to replicate your strategy. Nobody does that. They usually go and say, look, we just want to understand what you're doing, if we're comfortable with it, if it's transparent enough, and if you have processes related to data or viable, so on and so forth. If they can't give you that walk through it, then that's a sign. So I wanted to stop here with the formal slides. I want to mention one other thing though, or go into deeper into another aspect of the slides, which is why firms would do this. And then I think we can maybe open up the question. So I don't want to give the impression that it's all malevolent and firms are just out there trying to make a buck and this is a hot topic, so let's go in and make up a bunch of stories about how we're using machine learning and AI and go make billions of dollars. No, it's not that simple. I think with quantitative firms, I think you have to understand one thing. The more established quant firms, and I'm not saying all established quant firms are like this, but there are some that have built processes over the years, sometimes over the decades, and that process has worked for a large part of their existence, right? Now, if you are running this firm and you've made billions already and you've managed billions and you're still relatively successful, but you're noticing that there's a waning in the efficacy of your models, because markets change, we all know that, right? And your model was built using, let's say, old school methods, the regression based and so on and so forth. You may be thinking, look, we want to change, but if we change in meaningful ways, we're going to have to report that to our clients. If we report that to our clients, then they may say, what does that mean? We've been investing in a shoddy model for a decade or so? No, that doesn't mean that, but they may think that. And it's the fear of the perception that you've been using a shoddy model for over a decade that often keeps firms stuck to a model that is, by all accounts, fading in its efficacy. That's one reason. So it's a business-related reason, but not in the way that we think that these guys are sharks, they're just trying to make a fast buck. It's an actual concern for the reactions of their clients that may be unfounded. Maybe they're actually trying to do things in responsible ways, but they think that the clients are not going to buy that, so they shy away from it, and so they get stuck in an old model that is not really that useful anymore, and the performance maybe shows it, right? But they just can't move. It's almost paralysis. Another reason doesn't have to do with the clients directly, but indirectly. So again, it's a similar kind of a firm that's been using a certain kind of model or models for a long time. And they think that if they remove an important piece of it and they use a machine learning or AI sort of added piece, then like the game of Jenga, when you're taking out the pieces and trying to put them on top of it, the whole thing will fall apart and they don't know what they'll do with it. So they just have to go back to the old model anyway, right? Or if they test drive, if you will, the new model with the machine learning side of it, it's going to just crash and burn. Now, there's ways around that. You can test live money or pilot funds before you release them, right? So there's things around that. But I think this fear of taking a piece out and putting it in, it works for a while, but then falls apart later. And then we don't know as much about this model as we did about our old models, right? Because it's a newer technology, newer algorithms. That is another concern because the clients are eventually going to come to you again with that conversation. What happened? It was working great for 15 years. Now, now and then a year ago it was great. It was best you ever had. But then it fell apart quickly, right? They don't, if that happened, they want to, if they had to explain that, oh, well, we added a very significant portion of our process was modified to include machine learning elements. As you saw in the first 15 to 18 months, it was really producing a lot of alpha. We still believe in the process. We believe in the machine learning based process, but we've hit a rough spell. They will probably interpret that internally as, oh my God, we broke it. Now, then if they publicly go back to the old process, even though they may not, maybe the old process will actually been worse. We don't know, right? Then if they publicly have to announce that or speak to their clients, but then it looks like chaos because it looks like they don't know what they're doing, right? So I kind of give you a stylized example, but this whole idea of they have to be sure of what they're getting into, the client reactions, the idea of overriding their legacy, if you will, that's kept a lot of firms complacent. Now, what has happened though in the quant space, we've seen another set of firms years ago say to themselves, look, we don't care, we're going to have to evolve. They invested heavily in data, heavily in AI, and now they're reaping the benefits because they told their clients straight to their faces initially, look, we're changing. If we don't change, we're going to lose. And the clients that believed them stayed enough, I guess, because a lot of these firms are still going concerns, right? And they're successful. Some of them left, but then maybe they're coming back now when they saw the fruits of their labors, right? There's a whole other series of firms. I could rattle them off now, right? But I'm not going to for obvious reasons that didn't change. And you've seen it in performance, you've seen it in personnel, you've seen it in attrition, you've seen it in flows, right? That they didn't evolve, they didn't take those same chances, those risks on the PR side, client servicing side, and they are getting punished for it. Now, one last thing on the fundamental manager side, and we'll go to the questions here. Fundamental managers are a different boat. They don't have to use any AI, right? Because they can say it's my neural network that drives everything. I'm a genius and all that stuff, right? That's fine. I'm not making fun of them. The good managers, I used to want to work for the greatest managers ever. Bill Gross, I can go on record saying he never used the AI in his life, and I still respect him as one of the greatest investors ever. It was a pleasure to learn from him over the years. But not everybody is Bill Gross. Let's be honest. It's just the facts of life. Okay, and I'm not bashing anyone, right? It's just statistically. But the thing is that a lot of fundamental managers may feel that they're under sort of indirect pressure to use some of these technologies in order to not fall behind either, although they have a fine line because they can't use it so much that they become an AI quant manager now, right? So they're probably, I would say, less prone to AI washing, or maybe they were sort of accidental AI washers, right? Because they'll want to put in a deck, hey, we use AI too, we're very cool about it, we love it, it's great. But then when they're asked, do you really use it? They're like, no, it's just the process. So they kind of fall into an AI trap. I had this experience with a research provider recently, so not even a manager. I was talking to a research provider whose process I respect, and I would probably classify them as low-tech quant process, or it's like a rudimentary statistical process. But they have results over the years. And at the end of the meeting, the main principal of the firm is the founder. He says to me, Joe, hey, we also started to use LLMs. I said, wait a minute. I said, are you telling me that the old process, and he saw I was getting doubtful, is now being replaced or somehow significantly modified by LLM? And I said, no, that's not what I'm saying. He's like, no, it's the same process. We just run things through a LLM for second opinions on certain things. I said, okay. Then he almost fell into AI washing. Then he walked it back because we're not using it at all, really. That actually was good for us. Okay, good. I don't want you to change your process because it's basically fundamental. It works. There's no need for you to use something else if it's working still, right? So you see that for fundamental people, it's a little bit kind of, in a sense, more dangerous because they don't want to say they're using this in a real way, but they still kind of feel that pressure. So what I would do with a fundamental man is really press them. And if you press them a lot, they'll finally admit that they're not using it in a substantive way, and they'll kind of walk out of the washing. And that's probably good for you as somebody who's interviewing them. So I'll stop here and I'll open it up to the questions, and let's see what we got. Are we going to the floor, or let's see, are we going?
Hey,
I'm on the.
so Joe, I might kick off just while we're waiting for people to come up with questions, and certainly I've got lots of questions if nobody else wants to ask.
Okay.
Firstly, thank you so much. Fabulous framing. Certainly some questions there that we all need to think about on a day-to-day basis. And I think the transition that you raised, that you're either all AI or you're not, maybe that's a harsh reality that we've all got to face. But for traditional managers who've got an established process, how do they bring in AI to their process and still be valid? Where's the line where you go, oh, you're telling me it's not true? Is this how do you discover that? If I'm a asset owner, what are the sort of key tells that I can look for to discover that this manager that's telling me that they're integrating AI, what's the what's the two or three things you really look for?
Personnel.
Yeah,
I said before. I said it's really a big
yeah.
deal. Being honest
So
with you.
it's the type of person, their backdrop. It's not just that we've got these people doing this.
Yeah.
It's
So
what.
yeah, I mean, the thing is, I make a joke like, look, I've written a lot of papers on this. One of the reasons is at the end of the day, hey, I can point at that paper and say, hey, I know about this topic, right? I mean, I know something about it, right? I'm not saying everybody has to have a bunch of research papers. I'm saying that that's one angle, that's one dimension. Oh no, I understand what they're doing. Oh, good, good, very good. Maybe somebody didn't write a single paper in their entire career, but they used to run AI at a huge asset manager. Okay, that means something, right? If they built a system for a $1 trillion firm, and they came to a smaller firm to build it out, that gives me confidence. Okay. Number two, I think that there is a sufficient amount of detail, again, needs to be given as to what they're doing.
Yeah,
The secret sauce defense is very commonly used, but it's kind of BS, right?
yeah,
I mean, think about it this way. Um, I mean, everybody can't be Renaissance Technologies that says, look, this is the performance, here's the deck, it's 8 pages, you want to invest, you don't go away, right? There's a couple firms out there that do that, and one firm in particular, Renaissance is legendary. It's not anything, right? For doing this, they had a very opaque process. Okay, but not every firm. They did that after they had years of performance, where they took the risk actually to say that, right? To have that attitude. It may have fallen flat. People may have said, "Oh, we're pulling our money, we're not investing anymore," right? Or we're not, for whatever reason, they were successful in that pitch, but not every firm can be. And so I think you have to look for the secret sauce defense, because it's usually a weak one. It's one where it's put up because they really are not using anything substantive, right? Um, and then the third one is actually, again, simpler one. It's not the technical stuff. It's like, what problem was this designed to solve?
yeah, yeah,
Because that makes them say, oh, you know what? We couldn't solve this before. It's a little bit of vulnerability, right? But now we solved it with this. That's actually a pretty good answer, because then it goes, oh, they had a real problem. They actually gave a damn to actually use a new technology to solve something. And then it looks like they solved it. Now, that's another conversation. But the point is that tells me that the firm is actually trying to actually be proactive in what they're doing, right? And that's a good sign usually, when they can identify problems and then are willing to now use techniques that they haven't maybe mastered, let's say, completely, but because they're starting small and doing it. You mentioned one other thing I want to get at when you say that firms are under pressure to use it, and what kind of detection. One of the reasons there's all this pressure is because when they think about using AI and machine learning, it's automatically in an alpha generation context. But there's tons of application, risk, attribution, even
mm,
compliance, right? I mean, when I had my own consulting firm, which I sold right after a couple of years, I sold the IP to one of my clients. I was basically one of my biggest clients, and one of my biggest projects was building a natural language processing, NLP, to actually read contracts and other kinds of official documents for the compliance team. So there you go. That's a totally back
yeah,
office application, right? But it's not useless. I mean, it paid the bills for everybody, right? So the point is that there are ways of using things that are non-alpha oriented. That, hey, if you want to be a substantive real user of this stuff, why not start there?
yeah. I think that's a great advice, Joe. If I just push this a little bit further, then in terms of it, is there an operational threshold where you recommend a manager can actually market a strategy? I'm AI driven rather than AI assisted. Is there some degree of I don't know, percentage of decisions that are made materially with an AI model? Is there some sort of cutoff, or is it really case by case?
I'm smiling because you really hit on a really low AI assisted.
Yeah,
If you want to use euphemism for we don't use AI.
yeah.
I mean, so that's the thing. I mean, it's good that you brought it up though, because well, you got to ask them, what do you mean by AI? I mean, like,
Mm,
so I asked this research provider, what do you mean? He didn't say AI assistant. He said second opinion, but he knew he walked into it with me. I've known the guy for years, right? So it's not like I was gonna like, it was something bad blood, but it was like he knew, like, oh my, what are you telling me here? Are you saying you really change your process to get opinions from AI and actually drive what you're telling us? No, no, no. So you have to basically take up all those words and really tell, what do you mean by that? Now, decisions made, it's a great question. So I would say, like in the context of a compliance, well, hey, does this document, is it approved or not based on what the NLP is telling us? That's a good question, right? If the answer is yes, then it's totally AI is being used. If the answer is well, yes, but an analyst also looks at it, that's not disqualifying, but it's saying, okay, they're probably in an experimental stage where they're using it, it's real, but they also want a human analyst to look at it, at least for now, for this stage. If the answer is we look at what it says, but we have a human analyst make all the determinations on it, then it tells you it's kind of a fake application, right? So it's kind of like three levels, if you will, of use. And I'm sympathetic to the middle level where they're testing it out. They still want a human to look at it, but they take everything the AI says as seriously, right? On the investment side, it's a little bit clearer, I would say, in that you can hit it at different levels. Okay, are the directional decisions AI driven, meaning what to buy and sell? No, they're not. Okay, how about sizing? Yes or no? Well, so you can go down the line of all the investment decision making elements that we make as PMs, let's say, right? And you can figure out what level of granularity or decision making does the AI help with? Like, no, we still make all the decisions. Like, I can see a fundamental manager easily using AI to not make the directional decision or security selection, but then to do all the sizing based on empirical data and pattern recognition. Like, look, when you've had positive calls on overweights on this stock, these set of stocks, and you sized here, it was actually detrimental. You should have sized this way, right? So that's very useful, where it can actually help you empirically determine how to size on a go-forward basis. And that's a little bit lower level of decision making than the security selection. But you can actually say, well, where does it take? Now you can also say, look, maybe we don't use it for alpha on the alpha side. That's fine, but we use it on the risk attribution side. Well, that's great. When I was running quant at one of my prior firms, that's one of the first things I did. I said, we're not going outside. We're going to build it in house. And we built an entirely machine learning based risk attribution system. That's fine. That's good. I could say it's a real application of it, right? So it's those are the kinds of questions I would ask. Is it on the alpha side, ex ante, or is it on the ex post side, risk attribution, performance measurement? I don't think either one is, but obviously the alpha side is more impressive if they're doing it, it's successful, right? But if they're doing it on the ex post side and it's substantive, hey, that's still real. That's not washing. As long as we know what
Yeah.
they're doing.
Yeah. Hey Joe, just can you stop sharing the screen, mate, and then we can see you a little better. Thank you. I've got another question while other people are bringing up questions, and I'll keep going until we run out of time. I can tell you that now. If you think about the sort of minimum credentials or team composition or proofs of competence, what qualifies as being enough? What if I'm an asset owner? What's head of AI, data science? Is that the sort of thing I should be looking at? How do we verify that?
So it's a great question. I mean, I would say that the background's important, right? So, but in an investment context, and I know some quant firms don't look at the finance knowledge, unfortunately, and maybe it's worked for some of them, right? But I would say for me, I would like to have ideally somebody who knows the I mean, you don't have to have necessarily a PhD in computer science, specializing in in AI, but that helps, right? If you have a strong background and you've actually have applications geared towards finance, because financial data is quite different from data in natural science. So we could have a whole show on that, right? And so if you've never applied things to finance and you don't understand how the data works, I'm talking about not so much high frequency trading where you can apply different kinds of sometimes exotic or maybe more natural science inspired algorithms and get good results. I think when you have lower frequency trading like monthly or even weekly or definitely quarterly, a lot of asset managers operate on this basis. I think you have to have some economics injected into the decision making process. So I would look for some understanding of econometric models, because then they can also say, well, look, I understand how the econometrics work, GARCH or whatever it is, vector autoregressions. But then now I know how they're different from machine learning. I know, for whatever application, how to pick one versus the other. That's how I kind of came up in the business. I believe it or not, I had an AI background first. And then when I got to Wall Street, I had to learn all the econometrics from reading books, which I did. I'm actually quite proficient in it. Now I've written papers using very high level stuff, and it's kind of an area of mine. The thing is that I think you have to have both. Now the other question is that, Joe, that sounds like you need a PhD for everything. I don't know about that. I mean, let's say, but there are some credentials, right? So I'm also affiliated with another institution, the FDP, Financial Data Professional Institute. It started with Kaya. It's branched out now. So it's not plugging it or anything, but they provide a credential that is designed for professionals who want to get. But it's more like it's like a quant credential in essence, right? So it's not a competitor to CFA and so on, right? It's like trying to actually work through the algorithms, actually, understand how these things work in a very technical way, right? And it's something that if you have, let's say, a bachelor's in like a quantitative field, you could study for it, and that would give you, I think, a base level understanding of how these algorithms works. Time series analysis, how econometrics differs from machine learning, right? In sort of the basic but technical ways, right? The technical ways, and that would give you sort of the basis for further learning. It's not the end of the road, obviously, right? So I think, but I think if you have like a technical background or a computer science background, AI, then marrying that with, let's say, a CFA would be great, because then you get the requisite economics and finance background, and then you can have a better understanding of how that interacts with your mathematical or computer science background. But ultimately, what you want to do after all of this is to build and fail with models. So then you eventually learn how to build successful models, right? Because you'll always be referring to in life, like, oh, remember we did that and then we applied this, but you know what? That was oriented towards this. So it may not work it, but let's try it anyway. Or, sometimes you'll do things like you built, I remember one time we built a model using somewhere prior firm using random forest, right? And then there's something called a variation called adaptive random forest. Now, on the surface, it looks like there's just a minor difference between them. When we ran it, same application, we found out the adaptive random forest was so much more data thirsty for inputs that we couldn't confidently use its outputs, meaning its forecasts. So we crashed and burned that model. We used the old one. My point is that you have to kind of get experience using these things, because often the math itself is going to lead you to think things that are otherwise than reality, especially with financial data. So you have to have experience going through a bunch of these and using them, and then you'll be kind of an expert in like a small set of models, and then the other ones you defer to other people that have worked with it, right? So I would say get the requisite basic technical background and then start working with these things in real application. So I don't mean, yeah, hey, we have this model, one model from the textbook, chapter 8.5, and then we put in all this stuff, and we have 0, 1 constraints, right? On an unconstrained model, and it's giving us alpha. Well, join the list. Any signal that's worth its salt is going to give you alpha in an unconstrained model. What happens when you go to actual portfolio constraints that you would have to have in practice? Does that alpha whittle away? That's true for any quant model, not just AI or machine learning. But it's this kind of learning, right, that you have to go through, this iterative process of really getting realistic with the models. And here's another dirty secret, by the way, Shane, I want to tell you. It's often not one model that's going to get you there, but it's a hybridization or combination of two models, one model, each model handling one step of the process, let's say a trading model. And so that's another whole story, right? What two models do we put together, or three models? That's a whole nother problem, right? So this is the reason why there aren't that many strategies out there that are successful, because it's not as, again, it's not opening Tib Shirani chapter 6 and pulling out a thing from a textbook and applying it on, Yahoo Finance data and making billions of dollars. If it was that easy, everybody would be doing it, right? It's actually a multifaceted process, and the best way of getting to the end goal and the bottom of the rainbow is to get the requisite technical knowledge and just start breaking things, right? Experimenting, and get to a point where you start to have an intuitive understanding of what works well when. And I think then you'll be there.
Joe, we've got a lot of questions to work through, but we're running out of time. I'm going to ask one that I think is kind of valid for now.
Yeah.
Right at the top of the call, you're talking about AI washing and what are in terms of it being a risk. So what I want to know is, do you think the regulators are on top of that AI risk? Is there a regulatory overview that's coming in? It's very fast evolving. Is there any cases you're watching coming up that are going to potentially raise some questions for the industry?
I already cited those two public cases. I can't cite any others, but I will say the regulators are getting up to speed. I can't go into depth, but they are getting up to speed very quickly with educating their workforces, getting them more, teched up, if you will, skilled up. So I do think that I know this firsthand experience that the regulators are very much in tune to this and are getting there, which is good news.
Okay, well, let's hope they're talking to you, Joe, because I think you can be a good spirit guide on this. But I'm just going to ask one final question, and it really comes back to, when the rubber hits the road here on use of AI and investment. Is it too early to say whether AI is delivering better outcomes, as good outcomes? What are you looking for in terms of, is there some minimal statistical thresholds or business value thresholds where you think, hey, AI is the way to go?
Yeah, so I mean, I will say on the who's are we there? I think it's firm by firm. So the firms I mentioned, it's just an investment, right? And if you
Yeah,
invest in people and the money and the plumbing and the data, you got there. If you're not going to get there. Now the thresholds are simple in some way, right? If I used a predictive regression, OLS regression, and here's all my predictive stats and my alpha on live money, or let's say a sufficiently sort of realistic model simulation, right? Interactive brokers or whatever, right? And I have my machine learning model and it's beating it by measurable amounts consistently through using real data, historical and synthetic data in cross-validation, blah, 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 all the different tests that you can do. There you go. Then it has promise, right? Then it probably, I'm going to say probably should be pursued. I want to say should, normative term, but that's a good sign that it may be worth pursuing, right? So all of the thresholds on the investment side are similar to however we evaluate another model, alpha, RMSEs, predictive R squares, right? Time, the starting point, inception point risk, where we have it's all 30,000 basis points of alpha if we started in 1982, but if we start in 83, we're negative 5,000 basis points, right? So all those basic smell tests, right? It's the same stuff.
Yeah.
Yeah.
Hey, thank you, Joe. It's been a fabulous hour. We really appreciate you taking the time. So Dr. Joseph has said that next time he's in this part of the world, he's going to come and see us in person, which will be fabulous. Outside of that, Dr. Joseph's paper is available. It should have been with your invite. I know that he would love to get questions, and if there's anything we can do to help with that, please reach out. And we look forward to talking again soon, Dr. Joseph Simonian. So thank you so much for your time.
Thank you, everybody. Pleasure.